Welcome back to the channel. My name is Norton Ngo. I'm a real estate agent here in the city of Ottawa. And if you find this video valuable or learn anything new, all I can ask is you hit that like button and subscribe to the channel. If you have any questions on the market, you can also book a call directly with me through the first link in the description. Let's get into it. So you filled out every online mortgage calculator on the first page of Google, but you're still unsure about the mortgage approval process. Not to worry, today we're bringing you one of the top mortgage advisors in Canada, and he's going to give you some tidbits on the process. Recognized as one of the top 75 mortgage brokers in Canada, and as a finalist at the Canadian Mortgage Awards, and a member of the DLC Hall of Fame, Chris has a proven track record of success in the mortgage industry. Chris runs a high-producing team here in the city of Ottawa, and we're very fortunate to have him as a guest today. Welcome, Chris.
Thanks so much for having me. Really appreciate it.
No problem, man. It's a pleasure to have you on. And like I said, it's tough to line up the schedule with a mortgage broker, man.
While I'd like to say we're busy people, we're always happy to do this stuff.
100%, man. Like I said, we've had a number of questions. We end up asking a few of our clients. We're really excited to bring you on as a guest, but more so bring some of the questions that they had as well.
Okay, very cool. Yeah.
Actually, just to start it off, we'll tell a quick story about how we first connected with Chris. My very first client was an introduction through them. So we had a live deal. It was my very first deal. And Chris was brought on. I didn't even know Chris at the time, but it turned into a good result. And we're really happy to work together from there as well. So a couple quick questions. First and foremost, can you kind of provide some context to the listeners in terms of what the onboarding process looks like with working with the Allard team, kind of from start to finish? Like I said, we really want to break down how that process works and how your team works from start to finish.
Yeah, for sure. Great question. It's the question I get the most, obviously. In short form, when you're working with the Allard mortgage team, typically what will happen is that many of our clients have been introduced to us either via email or by phone, or maybe they found us on Google. And typically we get a notification from our website or connection, and then we usually reach out to that customer, introduce ourselves, and we have a dedicated person who does that. So my brother Phil, who's our rock star on the pre-approval side, is typically the first person reaching out to our customers if it's not me. And we will typically have a preliminary discussion, find out what that borrower is trying to do. Are they trying to buy their first house, their 10th house? What are they trying to achieve? And based on that, from there, we would build a preliminary file. That's basically us asking them what they do for work, where they live, and we try to find out a bit more about them that way. And following that dialogue, it can be as short as 10 minutes,
right,
we typically will send them an email asking them for a list of documents, which is typically income confirmation and ID.
Sounds good. Cool. Like I said, I think that a big question is people are just curious. Generally out there in the buyer space, they want to know. It's an open-ended question, but they want to know kind of how that works. So that's super valuable for our listeners out there. Again, this second question is something I really get basically on a day-to-day basis from our clients of why would somebody work with a mortgage broker? And honestly, the biggest difference is they want to know what value is derived. So like if you could break it down, what would be the value derived from working with a mortgage broker? And perhaps kind of the details in terms of like, it's such a competitive marketplace. So how would not only a mortgage broker, but yourself and your team kind of how differentiate yourself from such a competitive market space, I would say?
Yeah, well, just to be clear, I think it's important to define what a mortgage broker is, right? And a mortgage broker's job is really to understand someone's financial picture, share mortgage knowledge with them, and then find them the best rates and terms and products that are available to them. It's also a matter of helping them with their overall financial journey over a lifetime. Now, within the Allard mortgage team, we are brokers, which means we don't work with one bank. So we have access to over 50 different lenders. That includes banks, credit unions, and mortgage companies. And our job is really going to be to share mortgage knowledge with that borrower to help ensure that they understand the nuances between the different types of lenders. And we always try to empower the borrower to make educated choices. So the more we can share knowledge with them, the more likely they are to make a better educated decision on the right mortgage product, rate, term, and lender.
Right. Because I would say, like, honestly, when I first started in the business and just doing some more initial research, would you say almost like in previous maybe generations or previous buyers, like say my parents, for example, it was always go to XYZ institution because that's what they've always done. Would you say that in a previous space, mortgage brokers are almost like a second option as like maybe someone with bad credit or a very unique profile? Like, would you say that was maybe a perception even? I think perception would be a keyword.
Yeah, for sure. Absolutely. Yeah. I mean, the truth is we still help those borrowers who have bruised credit, but the average person that we help has the average profile. And historically, when you look at the 80s of the history of mortgage brokering, it used to be only bruised credit, people who didn't qualify at the bank.
Right.
And as things evolved in the mortgage broker community or in the mortgage broker world, let's call it, mortgage brokers started doing more business with banks, credit unions, and mortgage companies. And over time, that means our service became free because the lenders started paying mortgage brokers for bringing them business, which means now we can truly help borrowers on the best rate side of things, as well as people who are going through a bit of a challenging time.
So really across the board is an option that's available, because I think that's a big perception, was that I can qualify better at my bank at this institution, so I default have to go there, really, right?
Yeah, and keep in mind that with financial institutions, on a given day, one lender might have a better rate than a different lender, or one lender can do the file and one cannot, even in the best rate marketplace. So it's really about choice.
Right. Yeah, and I think that misconception really is that you guys work very closely with these A banks as well. Like, you guys have good partnerships with them, and I know you're always traveling the world, and you're always going to these conferences as well, right? Because you work very closely with these.
For sure. I mean, hey, the banks are the strength of the Canadian mortgage space.
Right.
I mean, names like TD and Scotia, these are reputable institutions that we rely on. And in fact, they not only do mortgages with their brand on it, but maybe a lengthier conversation another time is that a lot of these banks actually fund many of their competitors, which are the mortgage companies.
Right. Okay. That's very good to know as well, for all the whether it's first time buyer or other second, third, fourth repeat buyers. It's something to know as well, right? Yeah, I would say that, what are some major factors? This is a huge question for first time buyers. Like, what are some of the major factors that would go into determining borrowing power? That's often the golden question. People see a listing online, they're like, hey, how much can I qualify, right? Like, what would you say are some of the major pillars, would you say, that kind of go into the qualifying process?
The way that I typically describe it is that credit is the barrier to entry. What I mean to say is, if your credit is satisfactory or good enough, then you can get a standard best rate mortgage. But really, what helps determine the amount that you qualify for is more a calculation of what is your income compared to your debt obligations. So the higher your income is on the application and the least amount of debt you have, the more you will qualify for a larger loan. These days, with where rates are at, naturally it's getting more and more challenging to qualify for higher loan amounts, but that's kind of the short scoop on how it works.
Yeah, like we face on a day-to-day basis of like clients that, like I said, that example I gave, they see something online. We're in such a digital age that they see it online, but they oftentimes haven't really spoken to a person like yourself yet, right? So it's so key to build that preliminary file, like you said, right? So I think that for a consumer that's out there looking, what are some of the different products that are out there that you can dive into, of kind of what are the different products that are available for the consumer that they're just getting started and really want to educate themselves on what options are available? Because I think that's huge, right? Like we said, with the brokering channel, there's options available, right? So what would you say are some of the different products that are available?
So there's fixed rate mortgages, variable rate mortgages, and then lines of credit. So a fixed rate mortgage essentially means that you are guaranteed a certain interest rate for a certain period of time. And those contracts can be anywhere from 1 to 10 years, and the most common contract is 5 years. Right. So to be clear, a fixed rate means you are guaranteed a certain interest rate for that term length, which means your payments are guaranteed for that term. Repay it at any time. It's completely an open product. So these days, we talk about all three types of products, and when we look at the segment of how many people are taking fixed versus variable, we definitely have a stronger percentage that is with a fixed rate today because of where rates are at and from an affordability standpoint. But historically, when I look at my clientele over the last 13 years, it used to be 50-50. About 50% of people were fixed and 50% of people went variable. Right.
Okay, that's good to know. And we'll definitely dive into that a little bit further. But in terms of kind of there's so many different cases, right? Somebody that's on a fixed income, somebody that's self-employed. Like, do you have a certain, and I think you can relate to the clients very well. So is there a certain case or profile in which you'd recommend one or the other, like a fixed versus variable? Are there certain factors that you advise your clients based on for one or the other?
We definitely want to make sure that everyone considers their preferences, and we really try to have borrowers make their own choice, and naturally we nudge them in a certain direction. But to answer the question more specifically, I think there's two things to consider when you're debating between a fixed or a variable rate mortgage. There's many things, but the two primary factors are, firstly, cash flow. If your payments were to go up, are you still going to be able to afford the life that you live today? And two, economics. Do we think rates are going up? Do we think they're going down? What will save money over time? And so typically, we first need to make sure that the cash flow is okay. If the borrower is not going to be able to have higher, or they won't be able to manage higher payments, then in that scenario, it means that they probably need to go fixed because they won't be able to afford higher payments if ever things go sideways. On the flip side of that, if they are a borrower who can handle both fixed and variable, meaning cash flow up or cash flow down, then they are a person who could consider both. And that borrower who might consider variable will then have the choice to say, okay, well, from an economics point of view, do I think the variable rate will be more cost effective over time? If yes, go variable. If no, then you go fixed. And lastly, I don't want to take too much longer on this, but the two products have different penalty costs.
Right.
And so if ever you need to get out of a contract, it's easier to get out of a variable rate mortgage. So if you're someone who might be needing to restructure the mortgage sooner rather than later, perhaps having a smaller mortgage penalty becomes more important. And that means that a variable rate product might be best suited for that person.
Right. And that's super key because that actually dives into what I was a common question that we got from our clients and consumers out there was that if they're reflecting back on when they bought their home, a few of the responses were that they wish they knew more about options such as prepayments and what have you. So the question would be like, in terms of oftentimes some clients are just, give me the cheapest interest rate possible, like give me the lowest rate. But for yourself as an advisor, what would be other kind of key factors that you'd want to consider, such as, like I mentioned, prepayments and perhaps penalties? But if you were looking out for a first-time home buyer, what are other pillars that you'd want them to consider beyond just the rate?
Yeah, I mean, obviously there's a whole bunch of things to consider, but I really think that the penalty factor is the one that's the most often overlooked. The reality is many of the first-time home buyers that we help, they're probably not going to stay in that home for very long. The plan might be to do that,
right?
But first-time home buyers tend to transition. I mean, your life when you're 25 versus 29 versus 33,
right.
There's a lot of milestones in there. Maybe there's a wedding and kids and right. Objectives change and life changes and you might need to move. And so what happens if you need to break that mortgage contract? So the penalty is the one we spend the most time on. You mentioned prepayment privileges. So most lenders will allow you to pay 15 or 20% of the original loan amount each year.
Okay.
Most lenders are going to be super flexible. And then the other, I guess, additional point would be, can you move the mortgage from one property to another? So if you sell a home and buy a home, can you move that mortgage with you?
Right.
And again, most lenders will allow you to move that mortgage with you. So I'd say in most cases, mortgages are more flexible than we think they are.
Right. On the surface.
On the surface, but it's still important to dive deeper into those little nuances and truly understand what they mean. And if I can just add one additional point is that obviously we always want to get borrowers the very best rate. And in saying that, it's important to read the fine print because there 100%. Are some mortgages that you're not allowed to break, or there are mortgages that will have a larger penalty, or there are mortgages that you cannot move to a different property. And so we have to assess, is that small or big savings worth those additional clauses?
And the true opportunity cost of it. That's why I always tell them, it's like, you know what, it's first and foremost, like you said, very key. It's a contract. It's a legally binding contract you're signing. And it's important, of course, to look at the rate, but there's more fine print that's super important to that as well. So
for sure.
I think that's very important you brought that up. Speaking on first-time home buyers, I often hear is, what's the minimum down payment? So can you go into a little bit of the structure of kind of what the various different options are as a first-time home buyer putting a minimum down payment, and then with the team that with you and your team, with how much volume you guys do, like can you describe kind of the profile of your first-time home buyer that is putting their minimum down payment? So break down a bit of the profile of what your average first-time home buyer looks like, and then what is the minimum down payment?
I want to kind of separate that a little bit. The minimum down payment is not necessarily impacted by whether it's your first time buying a home or your 10th time buying a home.
Right.
So if it will be a home that you plan on occupying, meaning your primary residence or maybe a secondary home, you can buy with as little as 5% of the purchase price as a down payment. However, if you buy a home that's over $500,000, then it's 5% of the first $500,000 and 10% of the remaining amount up to $999,000. And then if you were to buy a home that's $1 million, you have to have at least 20% down, no matter what. So the more expensive the home, not only, the more you have to come up with as a down payment as well. Now, the second part of your question was specific to different profiles that we see.
Because we often, a lot of our clients that come across are like, they're looking into the space, right? Looking in the prospects of buying their first home. They're like, what does the profile of a first-time buyer look like, right? Like, who is out there buying these homes, right? They see the rising costs of housing. They're like, who are these consumers out there that are buying, right? So we see it, but can you describe kind of the profile that you often see come across your desk?
Yeah, well, naturally, with the prices of homes having gone up and rates being higher, oftentimes we're seeing first-time home buyers earn more than they used to. But that's not to say that the average population is earning more than they used to. And so what that means is for a lot of first-time home buyers, we're seeing mom and dad or grandpa or grandma being co-signers, meaning they're applying not only as first-time home buyers, but people within the family are also signing on to the mortgage application to show additional strength, adding more income to the application and qualifying for hopefully a higher purchase price. With that said, it's very easy to say that the co-signer will help the application, but it's not always the case. Mom and dad might have a mortgage. They might have a car payment. It's not an automatic that they help your file. And so we always have to assess that in advance. It's important to do that at the pre-approval stage, not once you've purchased the house. And because that's one that we hear a lot, like, oh, my mom and dad can co-sign, like, don't worry about it. Like, they'll do it. It's a bit more of a process, It's not just an automatic.
It's not like a superpower, automatic superpower. It's all good.
Yeah,
they're co-signing.
That's right. And the other thing that we see a lot of with first-time home buyers now, do not quote me on this, but if I'm not mistaken, there was a recent stat with CMHC and Sagen, which are two of the three insurers, and if I'm not mistaken, it's something like 25% of files that they're doing from first-time homebuyers do have gifted down payments. That's astronomical. We didn't used to see that 10 years ago.
Of course.
But I think that's just a sign of the times. There's wealth transition right now, and homes are more expensive. So if you're 20s, 30s, or 40s buying your first home, you might need some help from family.
And then kind of further to that, we've, on the real estate side, we see a number of different profiles as well. But, I call them different equations, right? So a single buyer with their parents, or a single buyer with a friend that they're both, they're buying as partners essentially, right? But maybe the parents are involved, right? Or maybe it's, the couple, they're together and they're buying with each of their parents helping as well, right? Like, are you seeing a lot of those come across your desk, really? Like different true equations of,
the truth is we see a lot of everything,
right?
And that's because we see a lot of files naturally, but it's because not everyone is the same. Everyone has a different financial profile. Everyone has a different moment in time that they're buying that first home. And so we often see friends buying together. We see kid and both parents. We see a grandparent co-signing sometimes. The other one that we've seen almost like a reverse, just to kind of throw that out there, is we're also seeing grandpa, grandma downsizing, and the kids are saying, well, if you downsize, maybe you can't afford the downsized spot. I know that sounds crazy, but we're seeing those scenarios because grandma, grandpa still have mortgages, and now they're going to be pension earners. And so we're seeing a lot of the kids almost helping the grandparents qualify. Because their income is reduced. From
an income level.
Yeah.
Absolutely, right. Yeah, that's interesting.
So it's one that we don't speak about very much, but once you're a pension income earner, there's only so much that you're going to make, and maybe the grandparents need help.
Right, totally changes that dynamics, absolutely. I think that's a huge topic. Gifted down payments, we see it quite often, right? And friends that are asking us, how are our first-time home buyers getting in the market? Can you elaborate on kind of how the gifted down payment process works? Like, it's not just miraculously XYZ amount of money appears in the bank account. Can you elaborate on how that should go about it, and maybe the due diligence that a first-time buyer, for example, that is looking to utilize that, call it a luxury, luxury from their family. Yeah. Can you elaborate on how that process would work and what due diligence they'd want to do?
I'm glad you said due diligence a few times. There's a lot that goes into proving the source of down payment. Yeah. So on any file, financial institutions, based on the law, are required to prove where the down payment is coming from whenever they get audited. And so they ask for buyers and borrowers to show a 90-day history of where the money has been. And so if you're getting money from a gift, at very minimum, certain lenders will require only a signed gift letter, which basically says, I am Norton's dad and I'm gifting him $100,000. And so, dad would sign that and then has to transfer the funds to your account. We have to show proof that it's hit your account.
Right.
Other lenders will also ask for a 90-day history of dad's account. And if there's a whole bunch of deposits in that account, that has to be tracked too.
Right.
So again, there's a lot of due diligence, and that's very specific to the anti-money laundering laws that Canada has.
Absolutely.
I always remind borrowers, like, the bank does not think you're laundering money, but they have to prove that you're not when they get
Absolutely.
audited.
So
And that's the challenge.
That's exactly it, right? Like that's what we're saying. So what you're saying is you can't just offer and say, oh, this is a gifted down payment. There's a lot more steps that have to go into it, because I think that in our space we see a lot of, and it's to no fault of the buyer, but it's more that they think that this is an extra tool that they can pull out of their arsenal, which is absolutely true. But there's steps before that have to happen as well, right?
Right. Plus, if we're doing a pre-approval, we need to know how big your down payment will be. You qualify for a different purchase price if you have $50,000 as a down payment or $100,000. So let's find that out earlier on. Let's document where this down payment is coming from, and let's make sure that we have you home hunting for the right purchase price.
Right. Totally shifts the optics of the file. Absolutely, right? So.
Absolutely. And keep in mind that there's different rules. Like if you're buying with less than 20% down or more than 20% down, there's different qualification guidelines. And so every little nuance of a mortgage application will make a difference. So the more you share with the mortgage broker early on, the better it will be.
Absolutely. We always tell our clients, it's like, you know what, keep the dialogue open, and more that what you tell the mortgage broker, it's better that you tell them at the beginning than it's a surprise at the very end, whether that be for good or bad. No, it's a gifted down payment of $100,000, great, but they want to know that. And with you also don't want to find out that you have a car loan as well, right? Which is, I'm sure, your favorite. In today's environment, I often get asked, speaking on that, how do car payments factor in? So we put together a quick little scenario here. Like, can we run through for the listeners to get a bit of insight, say Joe and Karen, they're first-time homebuyers making, say, $100,000. Round number, they're making $100,000 in salary. How much would, in terms of purchasing power, say they're leasing a car, it's about a $500 a month payment. Can you break down for the clients, generally speaking, kind of how much, because I think it's a misconception, really, how much that does affect the profile, right?
For sure. So I knew you were asking me that question. I wrote a few notes down and brought them here today because it's tough to give
100%.
answers on that type of thing.
No worries.
And it really depends on the person's income. In this case, you said $100,000.
Right.
It also depends on what the property taxes are on that house, because we have to take that into account when it comes to qualification. So a few quick notes that I put down were, if you earn $100,000 as a couple, you could probably buy a home that's roughly $525,000 with 20% down.
Right.
That means a down payment of $105,000.
Right.
That's assuming you don't have any debts. As soon as I add a car payment that's $500, let's say, that purchase price goes down to roughly $465,000.
There we go. That totally changed the optics of what they're thinking.
Now, in that scenario, I use the same amount of down payment, so $105,000 in both examples. Yeah. To answer that second part of your question, I think, was if the loan is $20,000, should they pay off the debt or not? Yeah. Again, there's so many things that go into this, and the house details specifically will make a difference in what the rates are at that given moment. Right. But if I assume that rates are, around 6% or so, the qualification will get impacted by a $20,000 debt, as we just talked about with the $500 payment. Yep. Sometimes, though, paying off the car doesn't necessarily help. And the example that I looked at was, if you have only $105,000 available and you now have $20,000 less as a down payment, well, suddenly with $85,000, that represents 20% of $425,000 as a purchase price. Right. That means your purchase price actually is even lower.
Even lower, because you have less down payment.
On the flip side of that, if we assume that you have $85,000 and you don't have to do 20% down for qualification, it bumps up the purchase price to about $450,000.
Again, still less than what we talked about. Absolutely.
So sometimes yes, sometimes no is the answer. Yeah. And it really depends on the overall financial profile.
But I think that's super helpful, because I think for the consumers out there, it's not always the obvious that having a car payment, it could impact the file quite substantially, right? And where, like we talked about, if you are unaware of this, you know what you're told as a broker, right? So it's really, if you find out this at the very last minute, that can totally shake up the optics of the file, right? So.
Yeah, the situation that happens a lot in our space. Keep in mind that we look at a borrower's credit report, and so typically we would know whether they have a car loan or not. But when they have a cosigner and the cosigner says, "I've paid off my house, I don't have a mortgage," but then it turns out that they actually have a line of credit on their house. That's a liability. It's a loan as well. Now the overall borrowing power is going down. So that's the real surprise that we tend to find out about. Right. Rarely will the car loan be the surprise.
Right. Or a last minute car loan, sorry.
Right.
Or they, a celebration of their house that they bought, they financed a car.
Right. So let's give a disclaimer here is that technically lenders reserve the right to ask for additional paperwork and reassess the file right up until the closing date.
Right.
And so if you originally did not have a car loan and then prior to closing bought a Benz, you might have a hard time getting that mortgage.
Absolutely. And that's a huge disclaimer that we want to always educate our clients on, that the structure of the file can change with little nuances that you make and decisions, right? So it's super important to do that due diligence that we talked about. In your eyes, this is a question that came from one of our close friends, is that kind of the decision to buy, right? So where they were asking, is it worth going in with a lower down payment and really having the structure of the CMHC mortgage insurance rather than to enter the housing market sooner, right? So say, I know there's a lot of moving pieces to that, but say you're a consumer, that is it worth it for them to take on that mortgage insurance and enter the housing market sooner as opposed to continuing to save up for your down payment?
Well, we have to consider qualification. Do you qualify if you have a smaller down payment or not? And then obviously, is it worth it to pay the insurance premium by doing the lesser down payment? I guess only time will tell as to what was really better, but I'm typically of the opinion that it's probably better for you to get into the market sooner rather than later, generally speaking, given that Canada has a supply issue. We don't have enough houses for everybody. And so I think the home prices will continue going up, which means if you can buy with a smaller down payment today, it's probably better than waiting to save, because the real estate market might outpace your ability to save.
Your net savings after that in that time period.
Yeah, but on the flip side of that, if you have the ability to do 20% down and you're debating between doing 20% down and let's say 10% down,
right,
it's always or almost always going to be more cost effective to do 20% down. So in that case, I recommend 20% down. Another little factor to this, if you are hoping or aspiring to build a bit of a real estate portfolio, well, maybe we do 10% down today, buy yourself an owner-occupied home, live in that, stacked condo for a little bit, and then maybe you want to buy a townhouse next year and occupy that one and convert the existing to the rental. So once again, we ask a lot of questions to find out about our borrowers, and we can help them navigate that down payment conversation.
Right. And I think that's so huge, right? Because there's truly no cookie cutter scenario, right? Like if that does become a rental, that first step into the market, right? What are their future plans essentially is a huge component of that, right? And like you said, I think a good feedback that we've always had from your team is that you guys ask these questions that really prompt them to think about what their future plans are, right? So
for sure,
yeah.
Absolutely.
And I think that in our experience anyways, there's just so many, in some cases people think it's a cookie cutter formula, right? Okay, this house, this down payment, right? But there's really a lot more that goes really into that, right?
For sure. I mean, not to get too crazy on this conversation here, but different income sources are the tricky part.
Right.
We can all fill in the box
right,
and plug in a number and say, this is my income and this is how much I qualify for. But will the lender actually use that income?
Right.
That's the real question.
Right.
So our job is to know which lender uses which income in
right,
certain dynamics.
And I think that's super huge. So, in today's environment, more and more people are both looking into doing, side hustles and side businesses perhaps, right? And further to that, people that are self-employed. Can you break down the process generally speaking? I know it's different for everybody, but can you give the listeners a little bit of understanding of how the self-employed space looks? And then we'll go into that first. So we'll go, how does a self-employed individual out there look to qualify for a mortgage out there?
So I'll start off by saying if we're talking about best rate mortgages, like a mortgage that we would help you get at a bank or a credit union or a mortgage company, the financial institutions will ask that you have a 2-year history, so 2 years of tax returns. That means your business is at more than 2 years old. Right. They're using your net income. So if your business grossed $500,000, but you told the CRA that you made 50, they're using 50. And they'll do an average of the last 2 years. And most lenders, if the most recent year is lower, they'll use the lower number of the two. So that's the black and white answer, I'd say.
Right.
However, if you are self-employed, there are certain programs where we can take your last 12 months of business bank statements and annualize them and show that you made more money. And there are programs like that in the best rate marketplace. There's just very limited lenders that do it. And there's definitely a lot of near prime or alternative or B lenders. Those are all synonymous words, just to be clear, but people refer to it differently. Yeah. There's a lot of B lenders that could do the file based on bank statements as well. So the self-employed space, there's a lot of scenarios. In the best rate marketplace, you can, again, still buy with less than 20% down. But if we're doing the bank statement route, you might still be able to, but if we have to go into the B space, the alternative lending side, then you have to have 20% down at least.
Absolutely. Okay. And then if we go to, say, a first-time homebuyer that we're talking about, that example, right? And then where they have these, like you mentioned, alternative income sources. Maybe they have around Christmas time a little side business that they operate, right? Can you elaborate on kind of what these side or additional income sources would be? One, other common, or two that are considered by lenders, right?
Yeah. So the side hustle, I definitely encourage. If you got a small business, I'm buying, I'm all for it.
Yeah.
When it comes to getting a best rate mortgage at a bank, credit union, or mortgage company, they can use that income, but the lenders will look at the last 2 years of your business and your actual normal full-time job.
Absolutely.
So if your business is starting to boom now and you're doing less hours at your normal job, that might impact your ability to borrow. The banking space is really looking for some stability. I personally want to support entrepreneurs, and I think the banks in general would like to, but the more uncertainty there is on a file, the less likely they are to do it.
Right. That's super helpful. And then especially over the last 2 years, a number of consumers, it was quite popular, right? They wanted to buy more house, really. And that was a very common thing that we're seeing, people going with the variable rate product over the last 2 years. And, given Bank of Canada's increases over the last 12 months and further to that, we're really seeing the effects of that, right? So if you had, to put your advisor cap on, what kind of advice would you be providing somebody that's looking into a renewal, say in the next 2 years? How would you kind of advise somebody that perhaps they were not working with you originally, but now, they came to you and your team? How would you advise them as they're coming up for renewal in the next 2 years? Because I think strategy is super important, right? And it's better to prepare ahead of time and be well versed as you approach that, right? Yeah. So how would you advise the client?
So firstly, the shameless plug for my team is that if you are an existing customer of ours, one of our team members, her name is Jennifer, she calls our clients twice a year to check in on them to see if we want to review the financial profile and plan for the future.
I didn't even know that. That's awesome.
Yeah, it's pretty cool. Now, if it's, you've recently been referred to us, you already have your mortgage and you're not sure what the future holds, I'm always happy to have a dialogue around. We essentially run a simulation to say, okay, well, if rates in 2 years are 4% or 5% or 6%, what are the payments? And let's get you prepared for that renewal. So if right now you're paying a 2% rate and the rate might be 5% at renewal, we definitely want to make sure that you're going to be okay with those payments. And so we try to encourage you to, if possible, maybe increase your payments now so that you're already going to be comfortable with those increased payments. Right. Or if it's not increasing your payments on your mortgage, at least allocating those funds into a separate savings account.
Right. To have that rainy day fund.
Yeah. And not only are you going to be used to paying that much on a monthly basis, but on top of that, you've got the rainy day fund. So we try to have those conversations, but I realize that the reality is that the cost of living is higher today, and so we just try to look at the specific scenario and help them out that way. We also try to say a few quick reminders, like how many subscriptions do we all have that we're just paying for on a monthly basis? I recently canceled the subscription that I had to The Athletic. I was paying $10 a month to a hockey or sports newspaper, and I wasn't even reading it ever.
I know you weren't reading it.
Right. So all that to say that in our planning conversations, we talk mortgages and yes, we talk cash flow, but we try to be pragmatic and have real life conversations with people and say and give tips and tricks.
Right. That's super helpful. And building kind of off that variable conversation, right? Variable rate conversation. We hear in the news that given all the rate increases that did happen, some variable rate mortgage holders are actually in what we would call negative amortization, right? Mm-hmm. Where they're not actually paying for any principal. So can you elaborate on how that one works and perhaps some counsel for somebody that is in that scenario, right? And again, it's a tough conversation, but how would that conversation go?
So let's try to just define that a little bit. In the variable rate mortgage space, and you asked about fixed and variable early in this conversation, and I didn't really elaborate on how the variable really works.
Sure.
There's two types of variable rate mortgages. One, where the payments are static. That means the payments do not change, regardless of whether your rate goes up or down. That's the specific scenario that you're asking about,
right? Which
is their payment hasn't changed. The rate's gone up, and now they're only paying interest on their payment. In fact, their interest is more than the payment that they have to make, which means there's interest accruing. Their balance is actually growing because they're owing more and more money to the financial institution. What I encourage those specific borrowers to do is to reach out to the institution that set up their mortgage and or to their mortgage broker and find out how far behind they really are. And every lender is going to have a slightly different strategy as to what to do. But typically the options are you can make a lump sum payment if you've got the money to do it. Typically they're going to give you an example of how much your payments could go up if you just wanted to pay interest only, kind of the bare minimum.
Right.
Or if you really wanted to continue on with your normal amortization cycle,
what you'd
have to be paying.
Right.
So that's specific to the variable rate mortgage that has the static payments.
Right.
And then there's also the variable rate mortgage where the payments can go up or down at the same time as your rate. And so many borrowers do have fluctuating payments. They wouldn't be impacted, like
by
the
that
static
negative.
payment that we're talking about.
I think having the conversation is the biggest part of that, right? Avoiding it won't go away, right? So it's having that difficult conversation to really face head on what is going on, and you can plan accordingly, right? I think that's super important.
Yeah, I mean, for your mortgage, for your finances, for life, for your relationships, I think communication is the key. Just, communicate, talk to people about this stuff, and you will find some answers.
Absolutely. This is something that came across our desk, and it was a healthcare professional. For recent graduates that are in industries such as healthcare and law, these are fields that they have continued education, right? So in terms of these cases, in some of these cases, they accumulate large sums of debt, but are highly regarded in terms of their employment after. How would you give tips to somebody that has this kind of profile, that maybe they're coming out of med school, they're coming out of law school with lots of student loans, but they're looking to purchase, or the prospects of planning to buy a home? How would you advise on somebody like that?
Let's use the med school situation. Year one residency, depending on what their specialization, maybe they're making $50,000. They have a $200,000 to $300,000 balance on their line of credit. If we use standard qualification guidelines, they do not qualify, they can't buy. Financial institutions, some of them have specialty programs. I'll use Scotiabank as an example. They will look at your year of residency, what your specialization is, and they will project what your future income might be. And then they use the projected income to determine what to use for the qualification, meaning you can qualify for a lot more than what you can truly afford today.
Right. The prospects of what you'd potentially make. Yeah.
The good part of that is we can get you into the market sooner. The thing I'm not as keen about, and I think it's important for people to be mindful of, is your mortgage payment might be outpacing your ability to pay because you are not earning the sum of money that you will in the future, yet we qualified it that way.
Right.
So I definitely encourage people to get into the market sooner rather than later. I said that earlier. With that said, let's try to be prudent and have a dialogue around how you will actually make the payments.
Right.
Just because I can get you approved doesn't mean you should necessarily do it. We have to have a plan for it.
Absolutely. And I think that's huge, because where a big conversation that comes about is oftentimes, can I qualify? And that's a yes or no question. But I think another avenue to that that's super important is the planning. Whether you reach out to Chris and your team today and you're not able to buy today, but you guys are able to outline a roadmap, if you will, right, to that healthcare professional that's able to buy, or the lawyer that's going to be making these sums of money in the future, building a roadmap for them, right?
Absolutely, for sure. Planning is very important throughout this entire process. And from a financial planning perspective, long term, I mean, I know this conversation is mostly around the first-time home buyer stuff, but we need to plan for people's retirement, or we have to plan for a mortgage borrower has kids who are going to go to university one day. We want to make sure that they're financially stable some way, somehow. And so it's really important to have dialogue around all these things.
Gotcha. This is kind of more future thinking type questions. Today's environment, especially when consumers are unsure of what term to take on, right? And I'm not going to ask you the crystal ball question, but what are some of the consequences of typically breaking that mortgage? So say XYZ scenario, they signed a longer term and they want to, circumstances change and they want to break that term. How does that work from a penalty point of view?
So number one, if you are selling and buying something else, you can perhaps move your mortgage to a new property. But if you are breaking your mortgage contract, every mortgage contract will have a different penalty. Yeah. Generally speaking, the general guideline is if you have a fixed rate mortgage, it is the greater of 3 months of interest, or this formula called an interest rate differential. It's a complicated formula that basically means if rates are going down and you break your contract, your penalty is going to be very big. Generally, again, big rule of thumb here, the penalty is probably somewhere between 1% to 4% of the loan amount.
And that's something to be cognizant of, for sure.
Absolutely. And just to be clear, that's specific to fixed rate mortgages.
Right. Yeah.
And there's different, if you're with a mortgage company, you will likely have a smaller mortgage penalty. If you're with a bank, the penalty is likely bigger. And then if I ignore fixed rates for a second and we talk specifically about variable rates, unless otherwise specified in the contract, it's highly likely your penalty is 3 months of interest. So again, variable rate mortgages are a little bit more flexible in order to get out of the contract.
Gotcha. Because I think that really speaks to the next question we have, right? For a lot of first-time buyers, a key element and talking point is beyond just that first term, right? They got their step into the housing market, but really planning beyond that. And I know your team's very good with that in terms of the ongoing communication. But if you could build on kind of what are some key insights and tips to be cognizant of when it does come time for renewal, right? So say Chris is coming up for renewal, say this year. What are some of the key kind of tips and tricks that a potential client should look for?
Are you mostly asking from like a qualification standpoint?
From a qualification point of view, yeah.
Yeah. So if you have a mortgage renewal, coming up. Number one, so long as you've been making your payments on time, the existing lender will probably offer you a renewal option, and you do not have to requalify. Lenders reserve the right to ask questions if they want, but typically the existing lender does not force you to requalify, which means that you could just sign and move along. On my end as a mortgage broker, I want you to find out what that renewal option is with your existing lender. And I also want to look at what the other options are. And so if I'm able to save a borrower money by moving the mortgage to a different lender, we want to be able to do that. The catch here is that we have to requalify. We have to collect income confirmation, ID, look at credit reports, et cetera.
Right.
I would say that very often we are able to move a borrower to a new lender at renewal. And that's because existing lenders most often are not giving their sharpest, best rate available to their existing clients, just because a lot of people end up just signing it and calling it a day. And so those are the moments in time where you should be speaking with your mortgage broker. There probably is a way to save money. And throughout the life cycle of a mortgage, if you are working with a mortgage broker, we will probably move your file to multiple lenders
over the course of the time.
Over the course of the lifetime. And just additionally, like oftentimes what we see, if it's a borrower that worked with a broker, when they bought with less than 20% down, they probably were set up with a mortgage company, because most often mortgage companies are most competitive with rates with less than 20% down. Once you have more than 20% equity, it's a bit more of a mix. Maybe we move you to a bank or a credit union so that you can access a line of credit. And then once you've got a ton of equity in your home, you're near the end of your mortgage lifetime, we're probably moving you back to the mortgage company, because again, the mortgage companies become super competitive in that space. So again, it kind of goes back to communication. We want to make sure that we're assessing all of the various options.
Right, because I think that's huge, because I think for people that are out there in the marketplace, it's what you talked about, right? It's almost like a subscription that you auto-renew. It's no questions asked, just do it, right? Mm-hmm. Whereas the due diligence that we keep referencing is super important to know what is at your disposal, albeit, like you said, collecting more documents and paperwork, but it could be saving you money ultimately, as opposed to auto renewing, right? Which could be a detriment in some cases. Right?
At least let's help you make an educated decision. Right. If you want to stick with the existing lender, that's okay too, but let's make the educated choice and do a bit of due diligence on this.
Gotcha. Cool. That's super helpful. What are, like, again, from a broker that has lots of files coming across their desk, whether it's first time buyer or repeat buyer, what are you kind of seeing in the marketplace? As we let's timestamp this. This is November, early November. So what are you kind of seeing across your desk in terms of activity, and as well as the structure that we keep seeing? Because I think that's super important for buyers to hear. What are our fellow consumers doing in the marketplace? What are you kind of seeing?
Yeah, I'm really pleased to say that we are seeing our inbound calls and emails for potential clients is just as high as it was the year before and the year before that. What that means is that there's a lot of people that truly do want to buy, or they truly do want to plan for the future to be able to buy. And I think that's really awesome. I mean, it means that even though we know times are a little bit tougher today with rates and inflation and cost of living, I don't know, I find it really exciting that there's so many people that are still trying to buy today and or planning for the near future. So I think it's important not to get overly discouraged with sometimes the negative media around rates and real estate right now.
Yeah.
There's a lot of people still trying to buy. And that's first-time home buyers, that's second-time home buyers, that's people buying a cottage, as a secondary residence. There is still transactions happening. It might not be as crazy as it was over the pandemic, but in a market
also out of the ordinary as well.
Yeah, that was totally out of the ordinary. I'd say right now our numbers have somewhat normalized. And my crazy prediction for the future is that I truly think that in 2025 things might be very busy for everyone in our industry, realtors and mortgage brokers and lawyers alike. And I say that because let's say for mortgage brokers, we have a lot of our renewals are coming up because we did them in 2020. They took a 5-year term, and then there's the 3-year terms that we did last year renewing in 2025 as well. And then on top of that, if rates go down, I think there's going to be a lot of real estate transactions, meaning people will be buying and selling.
Right.
So I think 2025 is going to be very busy. I still think that if you're able to buy now rather than 2025, I think it's going to be a more pleasant experience in the sense that you might not be competing as much.
And I think that's a huge conversation to have, because I think literally when I met you in 2021 it was just very frantic, and the environment in which our clients were transacting was a lot more stressful. Would you agree? Like in terms of you'd be calling Chris and it would go to his voicemail because there's 15 other people.
Don't say that on here,
I'm
man.
Just kidding. It'd be like, only for me, but like there'd be so many more inbound calls, and it's people that are live. They already bought the house.
Right.
They already bought the house, and they already want the answer to your question, right? So.
Yeah, for sure. I think another thing to consider as a potential buyer, let's say, is If rates are lower in a couple of years, you could wait and buy then, and hopefully your payments are going to be more manageable. But it's likely that home is more expensive. So your payments might end up being the same as they are today.
Absolutely.
With a slightly lower potential purchase price and a higher rate. Obviously, I'm kind of saying that on the assumption that rates are lower in a couple of years and that home prices are up. That is an assumption, but that's an assumption that is more of an educated assumption based on economists from CIBC and Scotiabank that I've recently attended presentations from.
And then in terms of the kind of regulatory side of the mortgages, do you anticipate hearing any changes to the mortgage industry as a whole, like whether that from the additional measures that are perhaps going to be put in place or maybe what you're hearing, and as well from the stress test? I know the stress test was implemented to look out for the consumers, but do you see any potential adjustments to kind of, again, you can't predict that, but are you hearing of any potential changes that?
The industry at large is talking about how there probably will not be a change to the stress test. Yeah. Most experts don't believe that the stress test today is very valuable in this moment in time. However, the regulators will be quick to point out how the stress test saved Canadians from themselves. And the stress test might be one of the reasons why people can still afford the homes that they have. So we don't predict. We don't see any changes to the stress test. Yeah. And in terms of other policy changes, our industry, Mortgage Professionals Canada, is really pushing hard to make an adjustment with CMHC and the other insurers specific to essentially what happens right now is if you have $1 million purchase price, you have to have 20% down. Right. That means people in Vancouver and Toronto need always to have more than 20% down. Right. And so we are lobbying or pushing the government to say, you know what, maybe you need to bump up that number and make it 1.25 or 1.5 million. And if they can make that change, I think it would help a lot of Canadians. So
right. I think the equation of $1 million is different across the country. Absolutely.
Well, it's the idea that this policy was created when the average home wasn't $1 million. And I know it's not quite $1 million, but in certain markets it actually is. And so it's essentially creating an environment where first-time homebuyers, many of them, can't buy purely because they can't save more than $200,000. That's a lot of money to save.
A lot of money to save, absolutely. And then just kind of in closing here, do you have any last tips for, say, let's call it prospective 2024, 2025 first-time buyers? Like you said, there's a lot of incoming inquiries in terms of they're curious. People are curious out there, right? Do you have any tips for people that are looking into the prospects of buying, but also perhaps in the early stages of the home buying process?
Well, I feel like I'm on loop here because I say this all day, every day. Get pre-approved sooner rather than later. Oftentimes I speak to people and I'll say, well, maybe I'll just take a little longer to get pre-approved because I'm not quite ready to buy. I think it's still important to get pre-approved today, even if you don't want to buy tomorrow, because at least if we've gone through the motion of figuring out what you qualify for, we can plan properly rather than waiting a year, realizing that we should have done something a year ago for the planning purpose. So get pre-approved early, as soon as possible, and plan properly.
Cool. Well, I look forward to continue working with you and your team, and I appreciate you taking the time for the interview.
Yeah, thanks so much for having me. I really appreciate it. Thanks so much.
Awesome.